there is a lot of positive news in the debt markets. To clarify, our role actually was for a change, not arranging the debt financing for TPG and CPP, but advising IMS on the sale. And so we actually did not act as a financing source. I would say, if the question is the debt market back for LBOs, I would say absolutely, but it's coming back in a measured way, which I think is actually good for all of us. We saw over the course of the spring and summer a real refinancing of all of the sponsor portfolios, where everybody looking at the debt cliff that was in 12 and 13, moving that out to 14 and 15. And we saw very significant depth of market and depth of demand for people to go out and extend their maturities in the LBOs that were done in 2005 through 2007. The next wave is obviously what happens with committed capital. And really the first deal that tested that market in any real size was Warner Chilcott. And Warner Chilcott attracted very robust interest from the banks, and has, in syndication, received a very warm reception for over $4 billion of capital for a public sponsor-controlled company in the mid-threes leverage. I think the next iteration is seeing the actual new LBOs. We've seen a couple of them. We saw Bush Entertainment. We saw Task for KKR and GA. We've now seen the IMS deal. And I think all of them share some things in common. People are moving up on leverage, but I think people have not forgotten fundamental credit skills. And more than thinking about the absolute leverage number, people are looking for strong interest coverage, cash flow coverage. Deals are coming at EBITDA less capex to interest of 2 times, plus or minus. And I think that discipline will be helpful. I think the next question will be, how big can you go? And do we see bridge capital come back? As most capital so far has been more mezzanine, privately placed, so that you know what the end buyer is at the time you do it, rather than traditional bridge to distribute. And I think the next wave of bigger deals will test how receptive the banks are to providing that intermediate piece of capital on a bridge basis.
What kind of pricing are people getting on debt? And also, are people able to arrange full financing packages, or sellers having to kick in seller paper? I mean, talk a little bit about the structure and pricing.
I think there are instances where seller paper creeps into structures, but it'll be much more an instance where the seller, because of the robustness of their auction, is forced to take that as a concession. If there's any robustness on the buy side, you're going to see fully financed debt packages. And in terms of terms, the market is pricing debt extraordinarily cheap right now. We're seeing single B bonds trade and price into the low double digits, and bank debt in the 7 or 8%. The difference is, where do the banks own it in a bridge scenario? And the banks are owning bank debt hundreds of basis points behind where the market will price it, and even greater gaps on the bridge capital, which is why many of the private equity firms are going with the mezzanine route. When bridge cap rates cross through the mezzanine barrier, and they're very close to it, but if mezzanine comes in the high 12s or 13s, when bridge cap rates come below that, I think private equity firms will go back to bridges and take advantage of the opportunity to do high yield that might be as low as 10 or 11%.
Do any of you, the private equity sponsors, have stories to tell about recent financings and shifts you've seen in the market?
Yeah, I mean, I think John alluded to it. I mean, we were involved in the Warner Chilcott situation, and John, was in the middle of that. I mean, I think John's absolutely right. That was a little bit of a different animal, because it was a strategic, a public company, strategic, acquiring another strategic asset, yet controlled by private equity. Fairly low leverage as well. But I think it was an industry in the pharmaceutical space, generic pharmaceuticals, that kind of set itself up well for financing. High free cash flow, very secure credit. But we were as we worked through that, we were pleasantly surprised that initially we thought we probably were going to have to all contribute some equity into that situation to effectuate that acquisition. And as as in the first quarter, second quarter, and then leading into when that deal kind of got done, the markets did improve quite dramatically, and we found that we could basically finance the entire acquisition, multi-billion-dollar acquisition with all debt financing. And I think John's right. I mean, what we've seen is, it feels like the markets have kind of gotten back to where they were, what I would say in like 03, 04, which is something around kind of five times leverage, if you will. It depends on what it looks like, but a mix between senior, high yield and mezzanine, some mixture there. And I think the one difference, though, is that the minimum equity requirements are still quite high. I would say we're seeing 35, 40% equity sections in most of these transactions that are getting done, which is a little different than what you saw in 03 and 04, where equity sections were a little bit thinner than that. I'd say more like 30% or so, maybe 35. But I still think that all makes for a market where there can be transactions that can happen, which are happening, that are priced appropriately for both debt and equity. I think that are good for both holders of those securities, and opens up the market again for sellers who have more confidence that transactions can happen at a larger scale. And so we're seeing all that. I think IMS is one example. TASDIL's another. I mean, these are coming, and they're more behind it. There are another transactions that I would say are in the $4, $5, $6 billion range that are in early stages of development. But I think you're going to continue to see that so long as the capital markets hold, because it requires that debt financing, I think, to make those larger deals, obviously.
Yeah.
Together.